I want to ask you something uncomfortable before we even begin talking about percentages, retirement targets, or complicated investment formulas. If you continue investing exactly the same percentage of your income that you invest today, will you actually retire free or financially pressured? I am not asking what you hope will happen. I am asking what the numbers realistically predict over the next 30 years. For years, I believed I was disciplined because I consistently invested 10% of my income without ever skipping a month. I felt responsible, organized, and honestly a little proud of myself for maintaining that steady investing habit. But when I studied the most recent retirement data from 2024, I realized something deeply unsettling about my situation. I discovered that doing what feels responsible is not always the same as doing what is mathematically sufficient. And that realization hit harder than any temporary stock market decline I had ever experienced before. Because the true financial risk is rarely dramatic crashes, it is quiet underinvesting repeated for decades. Before we go deeper into the data, I want to say something directly and sincerely to you. Yiton. If you genuinely care about buying back years of your life instead of simply upgrading your lifestyle, stay with me. Take a moment to like this video so more people can discover how small percentages shape long-term freedom. Leave a comment below telling me the exact percentage of income you are investing right now. And if you value clear, practical explanations of money without unnecessary complexity, consider subscribing to this channel. I am not here to sell programs. I am here to share how I personally interpret data and apply it responsibly. Tukun. Now let us talk about the tiny percentage that quietly determines whether retirement feels secure or stressful. According to Vanguard's 2024 How America Saves report, the average total contribution rate is roughly 12 to 13%. That figure includes employer matching contributions, which means the employee's own portion is significantly lower. The average individual contribution is closer to 7 or 8% of annual income. And yet, most people assume that contributing single digits each year is enough to guarantee long-term independence. POIS, Federal Reserve data from 2024 shows the personal savings rate in the United States hovering around 4 to 5%. That savings rate includes everything from emergency funds to cash reserves, not strictly long-term investment accounts. So in reality, the portion of income Americans consistently invest for retirement is often even lower than it appears. Let me make this simple and concrete using the current median household income of roughly $74,000. If you earn $75,000 per year and invest 5%, that equals only $3,750 annually. At 10%, you invest $7,500 per year, which still feels modest in the context of retirement goals. At 15%, the contribution increases to $11,250 annually, creating a significantly stronger foundation. That 5% difference between 10 and 15% represents $3,750 extra dollars every single year. Over 30 years, that difference alone equals more than $100,000 before even considering compounding growth. And once you factor in long-term market returns, that gap expands dramatically beyond the raw contribution difference. Historically, the broad U.S. stock market has averaged roughly 7 to 8% annual returns after inflation over long periods. I prefer using 7% in projections because it keeps expectations realistic and avoids overly optimistic assumptions. When you compound 7% annually for 3 decades, small yearly differences transform into life-changing totals. This is where the tiny percentage stops feeling tiny and starts feeling dangerously underestimated. Fidelity's most recent guidance still recommends targeting at least 15% of income for retirement savings. That 15% is not designed to make you wealthy overnight. It is designed to reduce the probability of future regret. In my opinion, 15% should be viewed as a minimum stability threshold rather than an ambitious goal. Once you cross 20% consistently, the timeline toward financial independence begins to shrink noticeably. At 25 or even 30%, the math changes your trajectory in a way that feels almost unfair. And yet very few households ever reach those higher contribution rates, even as incomes rise steadily over time. One of the biggest misconceptions I once believed was that earning more money would automatically improve my investing percentage over time. However, multiple economic studies show that as income increases, discretionary spending often expands at nearly the same pace. This pattern, commonly called lifestyle inflation, quietly prevents most households from meaningfully raising their contribution rates. I personally experienced this when my salary increased significantly, but my retirement contribution percentage stayed exactly the same. Instead of increasing my investment rate, I upgraded my apartment, my car, and justified those expenses as deserved rewards. What I failed to upgrade was the percentage of income automatically flowing into long-term index fund investments. That decision alone extended my projected financial independence timeline by several years without me realizing it immediately. Let me now walk you carefully through a realistic example so the math becomes simple and concrete. Imagine two 30-year-old professionals living in Texas, each earning $80,000 annually before taxes. Both individuals receive average annual salary growth of approximately 3% throughout their working careers. Both invest exclusively in diversified low-cost index funds, earning a conservative 7% average annual return. The only difference between these two individuals is the percentage of income they consistently invest each year. The first person invests 10% of income every year without interruption or changes in discipline. The second person commits to investing 20% of income from the exact same starting salary. After 30 years of consistent investing, the first person accumulates roughly $1.2 million. Under identical growth assumptions, the second person accumulates close to $2 million by age 60. The difference between them is not intelligence, luck, education level, or superior market timing skill. The difference is a repeated monthly decision about what percentage of income is invested automatically. That nearly $800,000 gap exists purely because of a consistent 10% contribution difference. And that financial gap often translates into 5 to 10 additional years of required employment. Corollary. To understand why this difference matters so much, we need to talk about retirement income replacement clearly. Financial planners often recommend replacing roughly 70% of your pre-retirement income to maintain lifestyle stability. If someone earns $80,000 annually, 70% equals approximately $56,000 per year. That $56,000 represents the yearly income needed to sustain a similar standard of living. Now let us apply the widely referenced 4% withdrawal guideline carefully and responsibly. The 4% guideline suggests withdrawing 4% of a diversified portfolio annually to reduce depletion risk. To generate $56,000 per year, you divide 56,000 by 0.04. That calculation produces a target portfolio size of roughly $1.4 million. Reaching $1.4 million is not unrealistic, but it requires consistency and adequate contribution rates. If contributions remain too low for too long, the math simply pushes retirement further away. At a 10% savings rate, reaching that target could easily require 25 to 30 working years. At a 20% savings rate under similar return assumptions, the timeline may shrink by several years. And at 30%, the projected timeline can shorten dramatically depending on salary growth and discipline. The important insight here is not precision, but directional impact driven by percentage differences. Even small increases in contribution rates compound over decades into meaningful shifts in outcome. B's. Many people underestimate how a single additional percentage point can alter long-term projections. For example, increasing from 10% to 12% can represent thousands of extra invested dollars annually. Over 20 or 30 years, those additional contributions experience exponential compounding effects. This is why the tiny percentage we are discussing is not emotionally dramatic but mathematically powerful. And once you truly see the math clearly, it becomes difficult to ignore the long-term consequences. Dorard, let me share something deeply personal that completely changed how I evaluate contribution percentages and long-term freedom. I once projected my retirement timeline assuming I would continue investing exactly 10% of income indefinitely. The calculation showed I would likely reach financial independence somewhere in my early 60s at best. Seeing that projection forced me to confront how casually I had treated such an important percentage decision. I realized I was unintentionally trading years of future freedom for temporary lifestyle comforts in the present. When I increased my contribution rate from 10% to 15%, the projected retirement age shifted meaningfully earlier. After raising it further to 20% under conservative 7% return assumptions, the timeline shortened again. The change did not feel dramatic in any single year, but over decades it reshaped my entire trajectory. What surprised me most was how manageable the increase felt once I automated the higher percentage. Automation removed daily decision-making and eliminated the temptation to delay investing until next month. Totti. Vanguard research continues to show that automatic enrollment meaningfully increases average retirement contribution rates nationwide. Employees automatically enrolled typically contribute 1 to 2 percentage points more than those enrolling voluntarily. That seemingly minor 1 or 2% difference compounds into hundreds of thousands of dollars over 30 years. Most households struggle not because they lack information, but because their systems are poorly structured. When investing becomes the default behavior, long-term discipline improves without relying on motivation alone. I discovered that financial consistency becomes easier when the system works quietly in the background. Instead of asking whether I could afford to increase my percentage, I asked whether I could afford delay. Framing the choice around lost years of freedom rather than lost spending money transformed my mindset completely. Each additional percentage point began to feel like purchasing time rather than sacrificing comfort. That mindset shift strengthened my commitment to raising my contribution rate gradually every single year. Kiru. Now let us examine what happens when someone never adjusts their investing percentage as income steadily rises over time. Suppose your salary grows from $80,000 to $100,000 within 10 years. If your investing rate remains fixed at 10%, your lifestyle expands while your long-term acceleration stays limited. Increasing the percentage even slightly during income growth creates a multiplier effect on total lifetime contributions. For example, raising from 10% to 15% at $100,000 adds $5,000 extra dollars annually. Parties. Over 20 additional working years, that difference alone equals $100,000 before compounding effects. When compounded at 7% annually, that additional stream can exceed $200,000 in value. This is why waiting until you feel comfortable often delays financial progress unnecessarily. Comfort rarely arrives spontaneously. It must be engineered intentionally through percentage adjustments. Many Americans focus heavily on picking the right investment, but ignore contribution rate entirely. Asset allocation matters, but contribution percentage frequently has greater long-term impact on outcomes. A perfectly diversified portfolio cannot compensate for chronically insufficient capital contributions. In simple terms, you cannot compound money that you never invest in the first place. I once spent months researching funds while ignoring the more important variable of contribution size. That misdirected focus delayed progress more than any minor expense ratio difference ever could. Once I redirected my attention to percentage first and fund selection second, clarity improved immediately. The sequence matters because contribution rate establishes the foundation for every other investment decision. Even moderate returns applied to substantial contributions outperform excellent returns on minimal contributions. This principle is simple, yet it is consistently underestimated in everyday financial conversations. The tiny percentage we are discussing quietly determines whether compounding works slowly or powerfully. Let me bring this back to something practical that you can calculate carefully for your own financial situation tonight. Take your current annual income and multiply it precisely by the exact percentage you invest every single year. Then compare that number with what 15% or even 20% of that same income would actually represent. The difference may feel uncomfortable at first glance, but discomfort does not automatically mean impossibility. In many real American households, the gap between 10% and 15% is smaller than expected. Often that gap equals one postponed upgrade, fewer impulse purchases, or a more intentional spending decision each month. Yet that seemingly modest shift can accelerate your financial independence timeline by several meaningful and measurable years. The real obstacle is rarely complicated mathematics. It is psychological resistance to short-term lifestyle adjustments. Human brains are wired to prioritize immediate comfort and visible rewards over distant abstract retirement security decades away. That present-focused bias explains why lifestyle inflation frequently outpaces retirement contribution increases as income rises. I had to deliberately counter this bias by imagining my 60-year-old self sitting across from me. I asked whether that future version of me would value upgraded possessions more than optional retirement freedom. That mental exercise transformed a theoretical percentage into a deeply personal and emotional trade-off decision. Once the trade-off felt real and emotionally grounded, increasing my investing rate felt responsible rather than restrictive. I began to view contribution percentage as a direct and measurable vote for my future autonomy. Over long periods, markets reward patience and steady contributions far more reliably than short bursts of brilliance. Contribution rate is the lever that determines how powerfully patience converts into compounded financial growth. If that lever remains too low for decades, even solid average returns cannot fully compensate for limited input. But when that lever is raised early and maintained consistently, the compounding effect becomes increasingly powerful. That is precisely why I call this a tiny percentage with consequences dramatically larger than it appears. Now let us address a difficult but necessary question about why most people never increase their contribution percentage meaningfully. The answer is rarely ignorance, because the information about retirement investing is widely available everywhere. The real reason is emotional friction combined with the illusion that small differences do not matter. When someone hears that increasing from 10% to 12% is helpful, it sounds insignificant. 2 percentage points feel minor compared to the complexity of markets, inflation, and economic uncertainty. However, over a 30-year investing horizon, 2 additional percentage points can represent hundreds of thousands of dollars. The market compounds contributions proportionally, meaning higher inputs create exponentially larger long-term outcomes. What feels small in a single paycheck becomes substantial when repeated every month for decades. This is why the conversation about retirement should begin with contribution rate, not stock selection. Many investors obsess over beating the market while neglecting the percentage that fuels compounding. I once spent excessive time researching fund performance while ignoring whether I was investing enough capital. That misplaced focus created an illusion of sophistication without addressing the foundational variable. Once I redirected attention toward increasing my percentage first, everything else became secondary. Even average market returns applied to strong contribution rates can outperform exceptional returns on minimal contributions. This principle is mathematically straightforward, yet emotionally difficult to prioritize consistently. We tend to overestimate the power of intelligence and underestimate the power of steady repetition. Retirement security is built less on brilliance and more on disciplined percentage decisions repeated monthly. Each month that passes without increasing a low contribution rate extends the financial independence timeline slightly. Those small extensions accumulate silently until retirement feels farther away than originally expected. And by the time many people notice, decades of opportunity have already passed. Gyoir, let me slow everything down for a moment and bring this entire discussion into sharp and practical focus. The difference between retiring free or financially stressed often comes down to one repeated percentage decision made every month. It is rarely about predicting recessions correctly, choosing perfect stocks, or timing economic cycles flawlessly. Instead, it is about how much of your income consistently gets invested before lifestyle expansion quietly absorbs it. If your investing percentage remains too low for too many years, compounding simply does not receive enough fuel. Quidi. And without sufficient capital consistently invested, even steady long-term market returns cannot create early financial independence. When you increase that percentage gradually and deliberately, you permanently change the slope of your financial trajectory. A shift from 10% to 15% may not feel dramatic today, but it transforms decades of outcomes. A shift from 15% to 20% can compress your required working years in a meaningful and measurable way. These adjustments are not motivational slogans. They are grounded in conservative compounding mathematics over long investment horizons. coite. The earlier you implement these percentage increases, the more powerful and forgiving the long-term impact becomes. The longer you delay those adjustments, the more aggressively you must compensate later with higher savings rates. I believe the most responsible financial question is not how much can I spend comfortably, but how much can I invest intentionally. That question reframes income as a strategic tool for autonomy, rather than merely a vehicle for consumption. Every additional percentage point invested today represents a measurable purchase of future time and optionality. Financial freedom rarely arrives suddenly or dramatically. It is constructed quietly through disciplined percentage decisions repeated monthly. The tiny percentage we discussed throughout this video is not emotionally exciting, but it is mathematically transformative. If you are currently investing below 15%, consider increasing it gradually instead of attempting extreme changes. Raise your contribution rate by 1 percentage point each year and automate that increase permanently. Because in the end, the percentage itself appears small, but the life it ultimately creates is extraordinarily different. Dorkizu.